Hey everyone, Naveen here from Windmill Capital on this edition of Ask Managers Anything. Today we're going to talk about India's favorite metal, gold. Just a month ago, gold prices reached an all-time high due to several factors including uncertain economic conditions prevailing at that time. However, in recent weeks, we have seen a decline in gold prices as volatility and uncertainty in the economy have reduced. The market sentiment has shifted and there is now a growing perception that the global economy, including the US, is displaying remarkable resilience. One of the factors contributing to the decline in gold prices is strengthening of the US dollar. As the dollar gains strength, it becomes more expensive for investors holding foreign currencies to purchase gold. This puts downward pressure on gold prices. Another factor is the anticipation of rising interest rates. When interest rates increase, investors tend to seek out other investment opportunities that offer better returns. As a result, the demand for gold may weaken, impacting its price. Another factor is the anticipation of rising interest rates. When interest rates increase, investors tend to seek out other investment opportunities that offer potential returns. As a result, the demand for gold might weaken, impacting its price. In the next part of our discussion, we will delve deeper into what influences gold prices. But first, let's start with a quick history lesson. Humans have valued gold all throughout history. The first recorded instance of gold usage goes back to 4000 BCE. A culture centered in what is today Bulgaria in Eastern Europe used gold to fashion decorative objects. By 1500 BCE, gold had become the recognized standard medium of exchange for international trade. This association of money with gold has continued into modern times as well. After the end of the Second World War in 1945, 44 countries came together to create the Bretton Woods monetary system. Under this system, the value of the US dollar was pegged to the price of gold. Other countries were required to peg the value of their currency to the value of the US dollar. While gold coins are not official currencies anymore and the Bretton Woods system has long been scrapped, gold is still an important store of value for investors and central banks. Why? We will see that in the coming sections. First, let's understand why gold prices hit an all-time high recently. In May 2023, gold futures, represented by the ticker MAUC1 on MCX, hit an all-time high of Rs 61,493 per 10 grams. Prices of the yellow metal have surged by approximately 24% since October 2021. This run-up is because of the global political crisis. For the uninitiated, Russia started a major military build-up near the Ukrainian border around April 2021. By Feb 22, Russian President Putin announced a special military operation in Ukraine and subsequently invaded Ukraine. Russia and Ukraine account for about one-third of the global wheat exports. Russia also is one of the leading producers and exporters of oil and natural gas. The war has resulted in disruption of the global supply chain, and this in turn has pushed up prices of food and oil, fueling high inflation across the world. While the IMF predicts that global inflation peaked in late 2022, rates in 2023 are also expected to remain higher than usual in many parts of the world. Here are some numbers to illustrate the current inflation rate and the inflation target for select major economies across the world. For April 2023, the US Federal Reserve System recorded a consumer price inflation rate of 4.93%, whereas the inflation target was a mere 2%. Similarly, European Central Bank recorded 7% inflation rate for April 23, whereas the inflation target was 2%. Bank of England, Bank of France, Deutsche Bundesbank, Bank of Italy, Bank of Korea, as well as India's own Reserve Bank of India have all recorded higher inflation rate for April 2023 compared to the inflation target. While central banks try to keep inflation under check by declaring inflation targets, as I have illustrated above, inflation across the world has been significantly higher than the central bank targets due to global macroeconomic issues. While inflation is one part of the rise in gold prices, there is another very interesting part, that is central bank purchases. This reminds me of a quote by American journalist James Solowiecki. Quote, "The world's central banks and the International Monetary Fund still have vaults full of bullion, even though currencies are no longer backed by gold. Governments hold on to it as a kind of magic symbol, a way of reassuring people that their money is real." Unquote. Central banks around the world keep a portion of their liquid reserves in gold. The share of gold in the total foreign exchange reserves of India has increased from about 5.88% in September 2021 to about 7% in March 2022 and further up to 7.8% in March 2023. It's not just RBI, but other central banks across the world have also been increasingly buying gold. In fact, central bank gold purchases in 2022 were at a 7-decade high. This trend has continued into 2023 as well, with central banks accumulating gold at the fastest pace on record in the first 2 months of the year. But why would these countries expend precious forex reserves to buy gold? When Russia invaded Ukraine, the US, in an attempt to punish Russia, froze Russia's forex reserves worth around $300 billion. In addition, it also introduced sanctions against Russia. These measures prompted other countries, especially emerging economies, to wonder if the US can levy a sanction on Russia's forex reserves. And these reserves have to be mandatorily located in the United States, by the way. There is no guarantee why the US cannot freeze their reserves too. Hence, the central banks of these countries have started buying gold. In 2022, central banks bought a record 1,136 tons of gold worth around $70 billion. Emerging economies like Turkey, China, Egypt, Qatar, Iraq, and India have been big purchasers of gold during 2022. The recent banking crisis in the US is another factor that is adding to the gold price rally. Over the course of just a few days in March 2023, 3 US banks failed due to a multitude of factors. This triggered a sharp decline in global bank stocks due to fears of global contagion. Investors were concerned that the crisis could lead to a global financial meltdown similar to the one that occurred in 2008. The interconnectedness of the banking systems means that the failure of multiple banks can have ripple effects across global financial markets and the economy. In such times of fear and uncertainty, investors seek safety and tend to move away from riskier assets like stocks. They shift their focus towards safer options such as gold, which is considered a reliable store of value during periods of economic uncertainty. The surge in demand for gold subsequently pushed its price higher. A recent World Gold Council survey among central banks from both advanced and emerging markets listed gold's performance during times of crisis, its long-term store of value, inflation hedging mechanism, no default risk, effective portfolio diversifier, and lack of political risk as some of the possible reasons that affect central banks' decision to hold gold. Some of the important takeaways for a retail investor from this survey are that gold as an asset class is very important during times of crisis, especially like the present Russia-Ukraine war. It is also an important hedging mechanism during times of high inflation and hence helps effectively diversify the portfolio. Last but not the least, unlike financial instruments issued by companies or governments, gold does not carry default risk. Unlike other financial instruments that are claims to ownership or money lent, gold is a commodity and its value does not change based on the issuer. Let's now test these claims. The first one was that gold as an asset class is very important during times of crisis. Whether it is the global financial crisis in 2007, Greek debt crisis in 2010, the global COVID pandemic in 2020, or the present Russia-Ukraine war, gold has always significantly outperformed Nifty and returned positive numbers, whereas Nifty has always yielded negative returns. The second claim was that gold is an important hedging mechanism during times of high inflation. We studied the performance of Nifty and gold during periods of increasing wholesale price inflation in India. In 2007, in 2015, and most recently in 2021, gold as an asset class has significantly outperformed Nifty during periods of increasing wholesale price inflation. Is there a relationship between the price of gold and silver? Gold has a timeless appeal as a store of wealth. It has relatively few industrial users, while on the other hand, silver has several industrial applications. Silver is widely used in electronics, solar panels, and even medical devices. So the demand for silver from these industries can really shake up its price. Gold prices tend to be more stable since its supply is limited, which has helped keep its value quite stable over the years. Unlike gold, silver hasn't quite proven itself as a reliable store of value. Its prices can be quite volatile since its industrial demand and smaller market size make it a bit more unpredictable. So silver cannot be relied upon as a hedge against economic uncertainties. It's more of an inconsistent performer with its ups and downs. Silver can and does follow gold prices on a day-to-day basis, but it can also have instances of over and underperformance against gold. Historically, silver has outperformed gold during periods of economic boom when industrial economies were thriving, but during times of economic stress, it has often taken a backseat to gold. So when it comes to the relationship between gold and silver as assets, it is influenced by a bunch of factors. Economic conditions, supply and demand dynamics, investor sentiment, and even geopolitical factors all come into play. As a result, the prices of gold and silver can move independently of each other or show some correlation at different times. So what should investors do? With no end in sight for the Russia-Ukraine war and expectation of continued high inflation rate in many parts of the world, there are enough triggers to boost the price of the yellow metal. The institutional shift to gold will definitely not stop suddenly. The future course of gold will be significantly influenced by how inflation develops and how the equities markets function. Investors will keep buying gold if stocks continue to outperform in order to get returns that surpass inflation. A portfolio that includes both equity and gold is an efficient way to achieve capital protection and create wealth in a sustainable fashion. Performance of gold will offset the poor performance of equities during unfavorable macro events or even persistently high inflation. Drawdown measures the downside risk of a stock or a portfolio. Due to the presence of gold in the portfolio, the portfolio's drawdown tends to be less than that of pure equity basket. A portfolio with moderate amounts of gold minimizes the risk of market cycles and is suitable for any investor seeking to create wealth over the long term. A portfolio that includes both equity and gold is an efficient way to achieve capital protection and create wealth in a sustainable fashion. Performance of gold will offset the poor performance of equities during unfavorable macro events or persistently high inflation. Drawdown measures the downside risk of a stock or portfolio. Due to the presence of gold in the portfolio's drawdown tends to be less than that of pure equity basket. A portfolio with moderate amounts of gold minimizes the risk of market cycles and is suitable for any investor seeking to create wealth over the long term.